James Babicz joining us, head of risk at SAS UK. James, regulators have announced the tougher standards following the criticism that last year's tests were not stringent enough. So they set a higher banking bar. Lenders will now be expected to maintain a core Tier 1 capital ratio of at least 5%. It's hoped this move will boost the confidence in banks as a way to weather the debt crisis. What do you think about that?
I think absolutely. It's definitely not an issue. Capital requirements are higher than they were. The methodology is more stringent. However, the challenge is, what is the impact to each individual financial institution? It's still that fear that we're setting a broad-based approach, looking at each individual financial institution from a common set of scenarios, a common framework, as opposed to seeing what is the individual risk within each financial institution. In other words, it's more important to understand each individual financial institution and its base business model and structure, rather than trying to have a one-size-fits-all approach. So I think that fear or that thought will still be in the back mind of the market in general.
Now, I know that you have pushed and said before for a 7% rather than 5%. They haven't reached that target. Do you think that they should in the future?
I think if we look at, from a market-based approach, 7% core Tier 1 is going to be the ratio that's used when Basel III is implemented. From that perspective, the market's going to be judging each of the financial institutions on that bar, on that ratio. So going to 7% is certainly what the market will be viewing in terms of the banks in challenges or having issues or in trouble. That's the bar they're going to be setting in the backs of their minds.
And what about these banks that fail ultimately? I mean, what are the options for them? I mean, some have mentioned that the Germans will bail them out.
Well, in terms of how each financial institution is going to be resolved, I think the argument's still in place. The stress tests themselves are not going to address the resolution of these financial institutions by any means. What they're really attempting to do is sort of give an indication of what are the issues, what are the next crises that are coming down the pipe, and get a forward-looking view, a business analytical view of what's happening in the market. It's certainly something we try to work with our clients to do in helping them understand not what's happened in the past, but what's happening in the future, or what the state of the market's going to look like and how they should operate from a business perspective in that marketplace. So in terms of resolving the banks, there are a myriad of opportunities or options out there. Contingent convertible COCO structures, bail-in structures, living will structures, these things have yet to be decided.
Now, as far as the credibility of the stress test, I mean, it came under attack last year and they're trying to shore up the credibility to boost investor confidence. Have they managed to do that this time around? Do you think there's much more credibility involved?
I think the key word here is a step in the right direction. Certainly the core tier, or the movement to core Tier 1, is more indicative of loss absorption of capital. If you look at what really needs to be viewed or stressed or analyzed, it's the exposure to sovereign debt, particularly in the banking book, and really an emphasis on liquidity of these financial institutions. Now, liquidity is being addressed by the EBA, but these are results that are going to be kept private as opposed to being made public.